let's take a look at the broader market now. Well, in the wake of that Fed decision and consumer prices, but also with a view to how we should be looking at our investment strategy for the new financial year. Darren Thompson joins us from Equity Trustees. Darren, good to see you.
Thanks, Andrew. Great to be here.
Interested in your initial reaction as to what we did hear from the Fed overnight.
No, it was interesting, and I saw your previous guest, and I think he outlined the situation quite well. In that, obviously the CPI print was quite soft, and obviously markets rallied, bond markets in particular rallied quite aggressively on that before the FOMC came out and sort of moderated that a little. I think the key point though is that, look, in our view, interest rates have peaked, and really it's probably really clear that the next move is down. It's just a question of when. And I think all we saw now is the confirmation that those interest rate cuts have been pushed out a little bit, but overall the shape hasn't changed dramatically. So we don't think it changes materially the outlook for financial markets over the next 12 to 18 months.
Is that with a focus on what we're seeing in the States, or does that also apply here? Because obviously we talk about maybe one rate cut in the States this year, more economists and banks coming to the conclusion now that we're not going to see a rate cut here until maybe even February next year. How is that influencing your investment decisions?
Yeah, I think that's right. I think there are differences, clear differences between the US and Australia. One clear one is being the transmission mechanism. We obviously have much more impact. Rising rates have much more impact given the variability of our mortgage system compared to the States. And also the US economy is stronger than what we've got here. We've got a very different sort of shape to our economy. So we would suggest that the a cut in the US is not out of the question, but it could even be pushed out into next year. But certainly I agree. I think that the RBA is more likely to wait and hold, particularly given some of the softer economic data we've seen coming out of Australia in recent times. Retail sales have been a bit softer. How will you measure it? We're in a GDP per capita recession, so things are a little bit tougher here, given the composition of our market.
So that said, how are you positioned when you're trying to construct a portfolio at the moment?
Yeah, it's an interesting time. At Equity Trustees, as you mentioned, we've got a broad range of clients, but many of our clients have a very long-term investment horizon. So we take a tactical view, but we also take obviously a structural view. Many of our clients, some clients we've had for over 100 years. Now that's a very long-term investment horizon. We have a lot of endowment and charitable organisations. So the key considerations for those organisations as we come into the financial year, there's two elements. One is they're very interested in the value of their assets, but they're also interested in the income coming from those assets, because those endowment organisations, charities and so forth rely on the income for their grading purposes and for their operations.
So you're trying to get a balance between growth and income?
Absolutely. We've sort of got that dual purpose of, we really want to maintain the real value of capital over time, but generate income for those purposes. And many of those clients are tax exempt, so we're also mindful of maximising franking credits and the after-tax income. So we're very tailored for that sort of market, and I guess that plays well to retirement income as well. Many retirees have similar considerations. So as we go into this year, our messaging as sort of those clients are setting their budgets and expectations are that income is probably going to be very similar. The outlook for earnings, particularly from Australia, many of our clients are overweight domestic equities because it is a higher income earning sector of the market, and also those franking credits are very valuable. But dividends in Australia the outlook is for them to be sort of very much flat. The banking sector earnings are very much muted in that area of the market. Resources are coming off their highs. So really other areas of the market are doing the heavy lifting in terms of balancing out those dividend yields. And I guess the other point we would make is that whilst the market is very excited about the prospect of interest rate cuts, it is probably quite a concentrated view around this soft landing, no landing view. So we would argue that valuations are reasonably elevated in equity markets, and that poses some degree of risk. I'm always a bit concerned when everyone graduates towards a fairly benign outcome. The risk is that things don't turn out that way.
So as we prepare for the new financial year, are you altering the structure of your portfolio then? Where are you trimming and where are you adding?
Yeah, we are just moving a little underweight growth assets, whilst that client cohort with that long-term investment horizon does mean that we will tend to be overweight growth assets over the long term. Tactically, we are moving underweight growth assets, particularly taking a little bit out of the US as S&P makes continual all-time highs. We do think there's a little bit of valuation risk in that market. In the domestic market, as I said, I think the earnings and economic outlook is reasonably modest. So we think it's going to be a tougher period for assets. Dividend yields in the market are already below 4%, sitting around 3.8, 3.9% in the domestic market. So again, that's probably a signal that either we're going to get a lot of earnings growth, which we don't anticipate, or that yields are going to be reasonably constrained. So we're underweight growth assets, and whereas 3 years ago, fixed income really didn't hold much of a place in our portfolios when interest rates were virtually zero, we are now allocating towards that part of the market because it provides both additional income and also I think it's a good negative correlation.
So what sort of balance do you have at the moment between fixed income and equities?
Look, generally we're still generally overweight and skewed towards equities, for that long-term investment horizon. But we've been moving some of our allocation on a tactical basis to fixed income and been elevating that across client portfolios. It really depends on the actual underlying client, and where they're sitting in terms of their risk and return objectives. But in all those portfolios, we're moving more towards fixed income as a component than we have been historically.
What sort of levels of cash you're holding at the moment?
Really depends by client. We're not heavily overweight cash, but we have put a bit more into cash so that we can opportunistically go back into markets if we do get a pullback.
All right. And you talk about that opportunity. So is that, and with equity-wise, is that sort of sector dependent, or are you more sort of bottom up?
We're certainly bottom up. We run a fundamental approach. Our acronym is quality at a reasonable price, which we think is a good through cycle investment that tends to gravitate towards companies with good return on equity, good cash flow, good dividend capacity, but also growth in dividends. And that's certainly where we're looking to invest. Sectors of the market we like within our portfolios. In the insurance sector, I'm not sure if you've received your insurance premium recently, but I certainly have.
I have, yes.
And the growth in premiums both within car and home is strong. Even commercial still is reasonably robust. So we still think there's a way to play out in that insurance sector. And then in terms of other components that drive income, we still think Telstra looks reasonably well placed. It's kind of an unloved, unfavoured stock in the market, but we still think that the resilience of that income and dividend stream is quite positive.